There are two potential scenarios that may occur when price taps into the inducement zones. In the first scenario, we see that the price reaches the inducement zone and initially shows a slight reaction. It then continues to move below or above the inducement zone, sweeping the liquidity that has accumulated in that area. However, the price eventually closes within the inducement zone, confirming the formation of a valid bullish or bearish POI pattern. To safely enter the market, it is advisable to wait for confirmation in a lower time frame. This confirmation acts as a signal that validates the trading decision. Without such confirmation, it is best to refrain from initiating any position. In the second scenario, price enters the inducement area and initially reacts slightly, but instead of respecting the inducement zone, disregards it. This leads to the triggering of stop losses placed above the inducement zone, resulting in a liquidity sweep pattern. Subsequently, price continues its movement towards the next order block zone located at the extreme. As mentioned earlier, the presence of a liquidity sweep pattern before price reaches our area of interest offers a high probability entry opportunity. This pattern signifies the absorption of liquidity and serves as a confirmation of the strength of the identified demand or supply. By recognizing this pattern, we can seize the opportunity to enter the market with increased confidence. Now, let's switch to the real chart and see some real inducement examples. On the screen, we have the 15-minute chart of the euro-dollar currency pair. It is evident that the price is currently in a robust downtrend. Furthermore, we can identify a bearish break of structure, characterized by the price breaking and closing below a previous lower low. By analyzing the chart, we have identified two potential supply areas where the price could potentially reverse and resume its bearish trend. However, the key question is, how can we determine which of these zones is safer to trade and more likely to be respected by price? Upon closer examination, we can see that the price failed to break the recent low in a single downward movement. Instead, it formed an internal low followed by a minor pullback to the upside. Subsequently, the price gained significant bearish momentum and experienced a sharp downward movement, ultimately leading to a break in the market structure. Consequently, we have identified a break of structure and two potential supply zones associated with the break. These zones have the potential to trigger a price reversal. One of the supply zones is located at the extreme end, while the second one is in proximity to the break of structure. As mentioned earlier, this zone can be considered an inducement. One reason is that price deliberately created a structure that would deceive traders into believing that price was about to change direction to the upside. However, as observed, this zone induced traders to enter the market with buy positions and place their stop losses below the internal low. But price subsequently moved sharply downwards, triggering those stop losses. Secondly, this zone appears to be a perfect bearish order block for smart money traders. Many smart money traders are likely to place their sell orders in this zone and also set their stop losses just above it. As a result, a significant liquidity pool is created just above the zone. As previously mentioned, inducement zones are strategically designed by large financial institutions, such as banks, to deceive traders into taking buy or sell positions in the market, ultimately generating more liquidity for themselves. Now let's see what unfolds next in the price action. As you can see, price initially moved upwards and reached the inducement zone, luring in more traders to open sell positions due to the temporary pullback. This pullback gave the impression that the supply zone was respected and that the price would reverse downwards. However, contrary to expectations, the price sharply pushed upwards, sweeping the liquidity above the inducement zone. Eventually, after mitigating the extreme order block, the price reversed and continued its primary bearish direction with significant momentum. Now, let's take a look at another example. Here, again, we have euro-dollar 15-minute time frame chart. As you can see here, price is in an uptrend and has formed a series of bullish BOSs. Within this context, we can identify these potential demand areas where the price could potentially reverse and continue its bullish trend. However, the crucial question remains: how can we determine which of these zones is safer to trade and more likely to be respected by the price? As we discussed earlier, we only consider a zone as valid for trading if a liquidity sweep pattern has occurred below or above it. In this case, I would not consider this particular decisional order block as my area of interest because the price did not sweep any liquidity before reaching it. Instead, I view it as an inducement area that creates a liquidity pool below it in the market. As you can see, after the formation of a new higher high, the price experienced a sharp downward movement toward the upper order block. At this point, the price showed a minor reaction to the inducement zone, which was influenced by the buying pressure from traders who entered the market with the belief that the price would reverse from the upper demand zone. However, contrary to their expectations, the price resumed its downward momentum and effectively swept the liquidity that had accumulated below the inducement zone, primarily caused by the stop losses of traders who held long positions from the upper order block. Additionally, we can see that after touching the middle order block, the price reversed and initiated a substantial upward movement to clear out the buy-side liquidity. We classified the upper order block as an inducement zone because there was no liquidity sweep pattern before price reaches it. As a result, the price did not reverse from this zone but instead utilized it as a source of liquidity, gaining momentum in the process. Conversely, the reversal from the middle order block can be attributed to the sweeping of liquidity below the upper order block. This liquidity sweep provided the necessary fuel for the price to move upwards with increased momentum. That's it, traders.